Ladies and gentlemen, good day and welcome to the Q3FY26 earnings conference call of Senco Gold Limited, hosted by Asian Market Securities. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during this conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Vikrant Kashyap from Asian Market Securities. Thank you, and over to you, sir.
Good morning, everyone. On behalf of Asian Market Securities, I welcome you to the Q3FY26 earnings conference call of Senco Gold Limited. Today, we have on the call with us Mr. Suvankar Sen, MD and CEO, and Mr. Sanjay Banka, Group CFO and IR Head. Without much ado, I now hand over the call to Mr. Suvankar Sen for his opening remarks. Thank you, and over to you, sir.
Thank you very much, Vikrant. Happy morning to everyone. We would like to start the call being grateful to all our investors for having their faith on us and on our team and on our performance. And we must say that this particular quarter has been a historical quarter for Senco Gold Limited. We've crossed 3,000 crore of revenue, an EBITDA of rupees 400 crore and a PAT of rupees 264 crore in this particular quarter. So this is something which becomes much more special because we have seen that this particular financial year has been one which has been extremely volatile. The gold prices have reached 1,40,000 rupees for that particular quarter. Post that, it has gone up furthermore, and currently it is in the range of 1,50,000 plus rupees. There has been a growth of almost 65% in the gold rate and about 23% in the quarter itself. But in spite of the high gold price, what is most encouraging is that the consumers have continued to keep their faith and confidence on the gold and jewelry as a category. We had Dhanteras in that particular quarter. The wedding season was in full swing, and keeping all those two aspects in mind, we have seen that in itself on the Dhanteras month, we have had a sales of 1,716 crores for the month of October. But very important that we as a team have kept in mind is that at these high gold prices, how is the consumer behaving? It is not that, the high gold prices is discouraging the consumer. It is rather that their faith and trust on the commodity of gold or silver as a category is increasing. It is only up to us as jewelers as to fit into the budget of the consumer, create products, whether it be in 22 carat, 18 carat, 14 carat, or even 9 carat, which became, allowed by the BIS agency, by the government of 9 carat hallmarking. And I think we can proudly say that Senco Gold and Diamond has been one of the first few jewelry brands to have introduced 9 carat jewelry in gold and in diamond jewelry as well. And it is this mindset of trying to understand the pulse of the consumer and fitting to the budget of the consumer that is allowing and enabling us to continue to sell and continue to grow. Our hyper-local strategy that we have been pursuing for the last 1.5 years, studying very closely on the local consumer needs, the use of technology in analyzing the data as to what is the exact product that is being sold at the store level in terms of design, in terms of budget. I think that all have played on, and it has become that much more important in today's day and time in analyzing the data and exactly placing the right kind of product that is going to fit into the budget of the consumer. Our franchisee revenue out of the total share has been 33%. The own store revenue has been around 65%, and 2% has been on the other channel sales. And I must tell you that this particular quarter, because the share of our own store channels have been higher than that of franchisee, that has been one of the major factors that has led to a higher profitability. The fact that our diamond jewelry studded ratio sales have also gone up by 38% in terms of value and 10% in terms of volume has also played a pivotal role in adding to the profitability for that particular quarter. Now, in terms of designs, we have launched more than 6,000 designs in gold and more than 3,000 designs in diamond for the quarter. New collections, new ranges, whether it be for weddings, whether it be for everyday wear, gifting. I think that has always, we have segmented all those various needs of the consumer and accordingly designed. Our philosophy and our vision is that Senco Gold and Diamond should be known as a house of design. Whether it be in jewelry or in other accessories, after all, being from a place which is of art and culture, design should be our forte, and that is what should make us continue to grow in the future. We have also seen that the growth in the Tier 2 and Tier 3 markets have been robust as well. Currently, we have got 196 stores in the whole network, and hopefully by the end of this quarter, we should be reaching 200 plus stores as we end this particular quarter. We need to look forward. This particular quarter, we are seeing Valentine's Day. It is tomorrow. So therefore, we are seeing a decent traction from the consumers with relating to diamond jewelry, everyday wear jewelry, couples coming and buying. So that has been, the Elements of Love has been the campaign that we have launched. The wedding season also continues to remain strong, and we are seeing that many consumers who are not only having weddings in the close proximity, but also in maybe 6 months, 8 months down the line. But in this volatile gold prices, they are thinking that these could be the good levels to buy, and they are preponing their purchases and buying. So we continue to see a strong, robust growth. This particular quarter, we hope that we should be 25% plus growth that will continue to happen. And going forward for the coming year, we shall remain focused, we shall remain strong, we shall want to drive our franchisee model in a much more stronger way, work on the diamond jewelry segment so that we increase our stud ratio, continue to work on the operational efficiencies, economies of scale, building the brand, and have a growth of 20% plus for the coming financial year as well. So thank you very much for all your ideas, all your encouragements, inputs, and we shall be thankful to our team for the great performance. Please, Bankaji, if you would like to say something.
Yes, sir. Sir, thank you very much. Once again, gratitude to our investors. So as we have said that for the quarter, the revenue has grown by 50% YOY to 3,000 crores. The adjusted EBITDA, like the EBITDA had grown by 406% from 80 crore to 404 crore. But if we look at the custom duty impact of in quarter 2 and quarter 3 last year, then the adjusted EBITDA for last year, quarter 3 was 107 crore, and this year is 404 crore. So the adjusted EBITDA margin is around 13.2%, and PAT has grown from 33 to 689%. But adjusted PAT, taking the impact of custom duty, it has grown from 53 crore to 64 crore. That is 390% for this quarter. And for the 9-month period, the revenue has grown by 30% consolidated. The adjusted EBITDA has grown by 133%. That is from 298 crore to 694 crore. And the adjusted PAT has grown from 139 crore to 417 crore. That is 200%. So it's very important to understand that while we have been talking about a sustainable business margin of around 7.2 to 7.5%, and recently in this quarter we have given a guidance of around 7.5 to 7.8 for FY27. So that is a full year margin, but quarter 3 margins are usually higher. So last year we had given a detail that our quarter 3 margin in 23 was around 12.1%. And quarter 3 margin in FY24 was 11.1%. So if we look at 13.1%, it should be seen in that context, because the sales are quite high, whereas the fixed OPEX remains the same. And if you look at, we have ascribed this to 2-3 reasons. One is your product mix has improved. Secondly, the lightweight jewelry, where the customer does not get the same jewelry weight as other jewelers, and then he is willing to pay extra prices to us, extra making charges to us. Similarly, the diamond prices which we are offering are quite attractive, and moreover, some impact of gold price rise has also come. Overall, this is on the financial side. The working capital requirement has also increased. So what you have seen is that the inventory value has increased from 2963 crores to 4602 crores. This has been funded by the borrowing as well as the trade payable. Importantly, we have focused very highly on the working capital efficiency and inventory management. We have implemented an AI-based software which helps us to monitor the inventory real time. And our inventory days have remained range-bound at 166 to 188 days. And going forward, we look at similar trend. In fact, if we look at other players, it is also in the range of 180 days. So as the stud ratio improves, the inventory days is likely to remain in the range of 180 days. Moreover, as far as the labor code is concerned, we have analyzed the impact of labor code, and we have taken a one-time extraordinary impact of around 6.2 crore. That's on the financial side. So we should see the result for Q3 and YTD in the context of custom duty impact of last year. Similarly, from the banking side, we have maintained a very good relationship with our working capital bankers. Our working capital limit, which is 2,400 crore, and our blended annual during the last year, due to this elevated gold price, we had to reduce the percentage of GML, and it got increased. The portion of CC and WCDL got increased, which led to our blended ROI slightly higher. We are very happy to note that our credit rating has been first-time credit rating, while our current credit rating is being done by ICRA. CARE Edge has done our second credit rating, and they have given us a rating of A1. So they are doing the rating for the balance entire amount, and we are very confident that with the enhanced rating from CARE, we can look at reducing the blended ROI by 30-40 basis points in next year. So with that, we pause our discussion and opening remarks, and then thank you very much, and we invite queries from you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Devanshu Bansal from MK Global. Please go ahead.
Hi, so Ankar and team, congratulations on a good performance and improving franchisee interest for the brand.
Mr. Bansal, are you there?
Yes, hi.
As there is no response, I'm taking the next question from the line of Mihir Shah from Nomura. Please go ahead.
I hope I'm audible. Hello. Operator, am I audible?
Mr. Shah, are you there?
I am there. Can you hear me? Am I audible? Seems like there's a unmute from your side.
Hello.
Hello. Operator?
Am I audible?
I can hear you. Am I
you are audible.
Okay, perfect. Thank you for that. So congrats on a great set of numbers. So firstly, just wanted to check on the guidance of 25% sales growth that you highlighted for 4Q. Given the gold prices where they are and the increase that we've seen during the last quarter and this quarter, it seems the 25% guidance seems quite low given the current momentum. Do you expect a material drop in ASPs in 4Q or a material drop in volumes which is leading to this lower guidance? So that is question number 1.
No, I do not see any material drop in ASPs. I'm just looking, if you look at the Q2 performance also, you will see that there have been a drop in volumes, even though the ASPs remain the same. So we are about 45 days into the quarter. In the month of March, there is Holi, the exam seasons go on. And then we also start looking at consumers behaving in a manner that on 19th of April, we have Akshaya Tritiya. So then consumers start, waiting for Akshaya Tritiya and auspicious day to buy. So yes, our guidance of 25% is little on the conservative side. Maybe, as we are closer to the end of the quarter, this 25 might become 30, 35. But we are still giving a conservative guidance of 25 to 30%.
Understood. So this is not a function of what you have seen thus far in 45 days of the quarter. Fair to assume that the growth momentum that we saw in third quarter continues in the first 45 days of the fourth quarter, and it is just the conservative way that you are thinking about it.
Yeah, we need to, we believe in that conservative way. See, the growth momentum of third quarter has to be also because of the Dhanteras, but, Dhanteras doesn't happen every quarter. Therefore, yes, it's that way to look at it.
Understood, fair point. Second question, again, is on the margin front. Margin improvement of 7.5%, it was indicated it was a function of the product mix improvement and lightweight having higher margins. So as far as the product mix is concerned, we probably thought if the studded ratio increases, but given that the gold in the stud gold prices are significantly higher in the studded, the margin profile for studded also goes down. Is that understanding incorrect? And if not, then what is driving the improvement in margin from 7.1 to 7.5?
See, when we talk about product mix, it is not merely the stud ratio. Obviously, on the diamond jewelry, the margins are higher. But there are different types of jewelry, right? Like you see in case of other players, with high bullion sale. In our case, bullion, we don't sell bullion. In our case, the coin sales, which I have said earlier, is around 4-5%, like 7%. And it is about the jewelry as well. There are different types of jewelry, different prices. If I sell more of antique jewelry, more of polki jewelry, as I said in the opening remarks, that if I sell more of lightweight jewelry, the effective making charge on lightweight jewelry is much higher. Moreover, with the gold price rise, since we charge the making charge on the value, while I would have paid a lower making charge to the carrier or vendor for getting the jewelry manufactured, let's say around 1,10,000 or 1,20,000, I would have paid him some 4-5%. But instead of charging 15-16% on 1,20,000, I am charging 15-16% on 1,50,000 or 1,60,000. So, due to the gold price rise, the making charge also increases. I am not talking about the inventory gain. So, that has led to improvement in the margin profile from, let's say, that's what we are saying, 7.8 or up to 8%. That is one. Secondly, in quarter 3, the mere sales volume itself is quite high. While the OpEx remains the same, that means rental, manpower, marketing and other OpEx remains the same. The sales volume has increased, and that's why we said that if you look at the margins in quarter 3 of FY 23 and 24, it was in the range of 12% and 11%. So we said that you can still look 9.5 to 10% as a sustainable business margin for quarter 3. For the whole year, 7.5 to 7.8. So if you look at the press release, when the EBITDA margin for 9 months is 7.8%, you can take 7.8 to 8% as far as business margin is concerned, and balance 2 to 2.5% you can take it to price rise.
Got it. That explains. Thank you very much, gentlemen. Wishing you all the very best.
Yeah, thank you.
Thank you. The next question is from the line of Bharat from MC Pro Research. Please go ahead.
Good morning, sir. Congratulations for a great set of numbers, actually. So just one confirmation, you indicated that FY27 sustainable EBITDA margin for the next fiscal should be in the range of 7.5 to 7.8%. Is that correct?
Yes, this is absolutely correct, provided the price range remains elevated. See, we are talking about the current price ranges. Otherwise, between 7.3 to 7.5 at an elevated price level, 7.5 to 7.8. So there is a gap of only 20-30 basis points, whichever way price moves.
Okay. And sir, next question is what would be the level of inventory hedging that we do currently, and what is the plan? So for 9 months FY26, so what was the hedging proportion? What is the intention for the hedging proportion in inventory hedging proportion in FY26, and the same for FY27? If you can provide guidance on the same. Thanks.
We've been mentioning that our hedging percentage is in the range of 55 to 60% for the last 6 months, 9 months. In the last 2-3 years, it has been in the range of 80%. There were times when we were up at 90%. But in the last 6 months, in this high price gold volatility, there have been pressure on liquidity. There have been pressure on maintaining the margins. And in this kind of a dynamic, volatile scenario, based on our prudent hedging policy and guidance, we said that let us keep it at 55 to 60%. That would ensure that we continue to focus on our business. We continue to manage our inventory well. And also, very important here to note is that the old gold exchange of the consumers have also gone up. So the old gold exchange, maybe 2 years, 3 years back, was about 25 to 30%. But that old gold exchange today is in the range of 45 to 50%. So when the old gold exchange comes in, then automatically those price risks that we always talk about is, partially reduced. And keeping all those aspects in mind, we've also started to focus on the customer advances with gold rate getting fixed. That itself also starts working as a hedging tool. So keeping all of that in mind, we've kept our hedging ratios in the range of 55 to 60%.
And sir, I just want to compliment here. When we are saying about the hedging ratio, it is only considering GML and MCX hedge position. But this customer offer which we give, where we give a fixed offer to the customer, it is as good as a future sell position. Or when we give a flexible offer to the customer, where the customer can go either way, those are the additional impact which we don't get into too much detail. These are the business strategies.
Okay. But sir, roughly, if we if you, as you said, fixed offer to customers is also given in the way of customer advances or this kind of a gold financing scheme. So what would be that proportion? So if we can get a sense of how the overall hedging works.
So we don't want to discuss those details. These are strategic points and they are calibrated from time to time. We just want to give you comfort that we are very cognizant of the risk management. It's a very the hedging policy considers the risk as well as the balance sheet both. And it varies from company to company. Let's say in the recent time when the gold price fell by almost 10% from 5,500 to 5,000, even 4,800. The balance sheet and how much margin call would have come around 400 to 500 crore. So it depends upon the jeweler to jeweler. So we have maintained a very fine balance between the risk management, business efficiency, and the balance sheet as well. I think I can leave it there that we are very much cognizant. This policy is approved by the board, and our large investors are fully aligned with our risk management policies.
Okay, so thanks for the clarification and all the best for my side. Thank you.
Thank you. The next question is from the line of Vijay Chauhan from Right Horizons PMS. Please go ahead.
Thank you for the opportunity and congratulations for a good set of numbers. So my question is, I have basically a question on the inventory hedging level side. So that has been answered. But is there any component of inventory gain, like we highlighted some less than 0.5% in quarter 2? So is there any component that you can provide as a percentage?
I'll explain to you. See, if you refer to our hedging slide in the presentation, accounting is done based upon cost or market price, whichever is lower. That is first point. So there is no inventory gain. Inventory gain for future. That means whatever inventory is lying in my balance sheet, it is at a cost price. So there is no hidden inventory gain lying, point 1. Point 2, in the gold price rise, when I take my GML and NCX position, there is, in a hedging position, it gives us a loss. So the balance sheet in a rising gold price, in a hedging position, in any extend the scope of my question, in any claiming to be 100% hedged or 90% hedged, the inventory will have hedging loss and not hedging gain. Whatever gain has come, the gain has come to the P&L account. But in a rising price, there will always be a loss. That loss is sitting in the inventory. So in quarter 4, when the price will rise, they will have a realization gain and adjusted by the inventory losses which are sitting in the inventory. You can kindly refer to my slide, and it is more of an accounting issue.
Yes, so going ahead, it is safe to assume that like typically the gross margin that we have around 9.9% for this quarter, so it doesn't have any inventory gain component, right?
No, the 9% is EBITDA margin. Gross margin is more than 15-16%. And we are
talking 19.9% for quarter 3 only. So it is 19.9 for gross profit. Yeah. So it doesn't have any component of inventory, right?
It has the impact of realization gain. So I am using two words. One is inventory gain and realization gain. Realization gain means whatever inventory has been sold at a higher price in the quarter 3, that we call realization gain. Yes, it has impact of realization gain, and I clarified it in the opening remark itself that 2 to 2.5% for the full year on a 6,400 crore. You can compute the number back of envelope. That is on account of price rise. Balance. So out of, I'm again repeating, sir, 10.8 is my EBITDA margin for 9 months, and out of that you can take 2.5% as a realization gain or inventory gain, whatever you are referring to. Similarly, in quarter 3, the EBITDA margin is 13.2%. You can take around 9.5 to 10% as the business margin. Balance you can take as the realization gain or inventory gain, which you are referring to.
Yeah, that answers my question perfectly. The second question is because we are seeing lot of shift towards the low carat products and also the studded item side. So can you provide some breakup of the range? Maybe let's say the plain gold jewelry has maybe 20% making charges or some margin and maybe 30% for the stud ratio. So is there any breakup or range that you can provide so that we understand that how the product category movement puts, let's say, positive pressure on the gross margin?
So, see, the gross margin is a function of own store sale and franchise sale. And we've said it earlier, and I'm giving you ballpark number. Let's say from the own store we make 20% gross margin. When we make a sale to franchising, we make around 7 to 8% margin. So you can take 60%, 35% and 5% on exports and e-commerce. These are the broad 3 areas. I'm repeating, sir. 60% own store sale, 30-35% franchise sale, balance 4-5% the e-commerce and exports. From the own store we make around 18 to 20%. From franchising we make 7 to 8%. From e-commerce and other we make around 5%. Now within this 20% of own store, I don't want to give you the breakup, so you can visit the store and understand that the jewelry making charges can vary from 6% to 25%. So if you want to go for an antique jewelry or a bulky jewelry, we can charge around 24-25% along with discount in the respective period.
Okay, so these are net of discounting that this range you are referring, right? 6 to 25%.
These are the gross amounts.
Yeah,
these are the gross amounts.
Okay.
It will vary from time to time, sir. These are based upon market dynamics. These are based upon the competitive situation in the market and the competitive advantage. And as you are aware, we are a second most trusted brand. The customers are willing to give us extra fee for the trust and faith and the comfort and the design.